Step into the fascinating realm of industrial metals, where steel prices fluctuate and market indicators are the pulse of an ever-evolving industry. Welcome to Cup of Joe, the metal podcast paying homage to our founder, Joseph T. Ryerson. Settle in, savor a cup of Joe, and let the conversation begin.
Welcome everybody into the Metalverse. I like saying the Metalverse now. It's something I think has caught on.
It's a beautiful place.
August, and the summer's going by really quick. But it's been a while since I've had a chance to chat with my buddy Nick Webb. Nick, what's going on, man?
Not a whole lot, man. I missed you, at least live in particular. Yeah. It's been a couple of months. I think since maybe May was the last live one we did.
It's got to be.
I don't even know.
No, June. I think June.
Okay.
We did June.
Okay.
Yeah.
Beginning of summer.
Yeah. For those of you who don't know, he's got a big office in front of me at the office, so I see him sometimes just through the window, but we only get to talk once a month.
That's right.
Kidding. Lot going on. It's good to connect again and get this going. Big day. It's August 1st. The Bears are starting. They play a game tonight. I know you're heavily invested in the Chicago Bears. Last year you put them on somewhat of a winning streak and back on track.
That's right. It's going to be interesting to see what Caleb's got up his sleeve this year.
Well, now that they don't have that Ohio State quarterback, they'll probably be all right.
That guy was trash.
Yeah, I know, right? Where did he go to school?
And I think this is the first time we've had the Olympics going on while we've done a Cup of Joe as well.
Right. Yeah. Exciting stuff there. We don't want to do spoiler alerts for people that are watching live, right? But there's some good stuff going on in the gymnastics right now.
Yeah, all in the last hour or so. Yeah, pretty exciting stuff.
Yeah, really good. We got a lot to cover. A lot's going on since we were last live. But before we get going, what's great about this show is you get a lot of interaction from the audience, viewers. We get a lot of great questions. We get a lot of emails before and after the show. There's one of our colleagues that always gives us encouraging words. I know he texts me and Nick and our producer Jason often. Good luck with the show. Or great show. Love it. Rudy Tank. He's our vertical market manager for heavy equipment, and he's retiring at the end of this month. 25 plus years in the metal industry, I believe.
Amazing.
Yeah, and he's always have encouraging words for us. So Nick and I want to make sure. Congrats on a great career, and just phenomenal, and it's on to the next chapter. But I know he'll be listening to Cup of Joe and hopefully giving us those encouraging words even beyond August 30th.
Yeah, exactly. Hopefully he keeps tuning in.
Yeah, I think so. I think he will. He will.
Big thanks though, Rudy. Absolutely.
Yeah. Good stuff. And another big happening coming up. We're not going to be live the first Thursday of September either. We're going to kick it to the following week because Nick's got some big news going on the first week of September.
Yeah, I had to go and be selfish and get married here in about 30 days. And then with the honeymoon, unfortunately, conflicts with recording a Cup of Joe. So yeah, I figured, you wouldn't want, some sort of winery or something in the background, because we'll be actually out in the Napa area for a couple of days. So probably not going to have great cell phone, service for internet, but so we're going to push it to the following week.
Well, congratulations. And
thanks, Mike.
Yeah, you shouldn't have scheduled it the first week of the month. We should have did it on location.
I did let her know that. I let her know there were going to be some pretty upset people, but the show must go on.
Yeah. Well, no, congratulations. And some good stuff. And I promise we'll get to the show here in a second. I have one more thing to plug here. We have our Metal 103 coming up at the end of this month. Metal 101, educational webinar about all things metal, all the different grades and whatnot. Metal 102 is all about fabrication. Metal 103 is going to be kind of a special, I don't know if you call it like an advanced course or a graduate course. It's on additive manufacturing. We
awesome.
We have a company that we invest in called Freeform, and we're going to educate what are the right parts for additive, what is additive, how you go about the process. So if you're interested in that, there's a link in the chat below to register, and I think it's going to be really informative. And we've had Chris on a previous episode, a Cup of Joe, talking about additive manufacturing as well.
Excellent.
So that'll be a good one. All right, I'm done with all my commercials and congratulations. So let's get on to the meat of the
Well,
presentation.
it sounds like before we hop into metals, we're going to be talking politics for a couple minutes, which could get a little spicy, huh, Mike?
Let's get a little. Why is anything going on the political front?
Well, before we get into it, we're going to reemphasize these are the opinions of Nick Webb, Mike Carrazzo. These are not the opinions or views of Ryerson as a whole. Do your own research, but we think we've got some great content here for you today. But yeah, before we hop into the macro and the metals content, Mike, I'll let you go ahead and introduce what we're looking at here.
Yeah. So, I mean, obviously it's an election year. We've been talking about it on the episodes here. We have the metal perspective, which we do twice a year. We do once in the beginning of the year, once near the end of the year, just kind of getting a pulse from our customers on market conditions and whatnot. One of the questions we asked, and these are preliminary results. We just sent out the link to take the survey, but we asked, should there be a change in the U.S. administration in this upcoming election? How do you anticipate that it's going to impact business conditions? We're not saying there will be, just saying that if it should happen, right? And if you see here on the screen, close to 40% are saying they anticipate things to get significantly better with a new administration, while another we'll call it like 35 say somewhat. I don't know, what this speaks to, but it's certainly on the mind of a lot of folks for sure.
Yeah, for sure. And I think, with the turbulence that we've seen, I think somewhat unprecedented in terms of the incumbent president stepping down. In a way, we're getting a new administration regardless. It's either at this stage going to be most likely Kamala Harris or Donald Trump. So in a way, we are getting a new administration definitively. So there might be some nuance to this question, actually. But, obviously, Mike and I aren't going to get into the discussion of which president is better or worse for the country or better or worse for ourselves. But I do think we can probably take this context and maybe split it into, what might people be looking at to say things get quote unquote better or worse within the manufacturing and metal space.
Yeah. Great point about like it'll change. I mean, it won't, the administration might not, but there'll be, Joe Biden will not be president. There will be somebody else in office regardless.
Yeah, exactly. Yeah. And it got me thinking about a slide and a table that I'd come across in the last week or so. This is put out by Goldman Sachs. And they're kind of discussing the same type of hypothetical of, should the administration change in a material way? I suppose that would be more of a Trump type route. What changes could we expect within the manufacturing world? And I think the vast majority of it at this stage is mostly linked to the Inflation Reduction Act and some of the policies surrounding that. I think we can talk about some other aspects of potential policy, but specifically on the IRA, I think the argument would be, should an administration come in that's Donald Trump led? I think things like EV mandates, so electric vehicle mandates, wind subsidies, solar subsidies, and then this DOE loan program, which is it's basically a debt fueled financing package that's for large scale green energy projects. All of these things really have a similar motif through them, which is they are all kind of themed around climate change, greenification. And should we have a change of administration that way, the belief is that some of those would actually be at risk. Whereas I think the alternative, should Harris become president, I think many of these things have been put in place over the last 3 to 4 years, not only maintain, but may even scale up. So I think, if we're trying to pick certain industries that may be winners versus losers, depending on the industry or depending on the outcome of the election, I think this is certainly a heavy point. If you look more broadly, go ahead.
I was going to say, where does construction ride into this, right? Because obviously that rides the wave of interest rates heavily, and it's struggling right now because of interest rates. But I mean, I know it's not listed here, and it's probably not too closely tied to the election or whatnot, but more tied to interest rates, right?
Yeah, I mean, thus far, I think from a policy standpoint, I think both of them kind of have a general support of let the IRA continue down the path of the way it's going. Mm-hmm. So I don't think there's going to be a whole big reshuffling there. Certainly your point, and we'll talk about interest rates here in just a couple of slides, interest rates coming down, and that shouldn't be politically motivated. That should happen. I think the path of interest rates is going to be the same or should be the same regardless of what president is in office. So I don't think that's going to move things too much. But I think when you look more broadly, I'd say this is sort of a good news, bad news situation. When you think about things like spending, I would actually make the argument that both sides of the aisle are pretty big on the path of, deficit spending, spend to grow, that sort of thing. So I don't think there's a real big differentiation there. Again, if we're thinking about, our participants of the survey saying things are going to get better, there is a potential argument that, should there be a Trump administration, there's definitely a continuation or an elevation of tariffs and protectionism. Already, he's been pretty vocal about wanting to put in place a 10% tariff on all imports of all products, which again just makes us more U.S. centric or I'd say USMCA centric, perhaps. And then further 60% tariffs on any products coming out of China. So those would be pretty dramatic step ups, which it doesn't necessarily mean good or bad. I think it depends on what type of industry you're in, whether that's going to impact you positively or negatively. Certainly, there could be some inflationary type tailwinds of some of those things because you are bringing things into a more expensive country.
Yep.
Those are some of the items that I think participants may be thinking about when they're trying to say whether one president is better for their specific company or not.
And I will say, we encourage you. Like I said, we just launched the survey. We would love your input on this survey. We're going to put the link to that survey in the chat as well. So if you wouldn't mind, go in there. It's 10 questions on the market, and we'd love your opinion. And we'll unpack the results on a future episode of Cup of Joe, like we did in the past. But one other thing I wanted to point out is we covered this maybe a little bit earlier in the year. And you and I've had conversations a lot about this, but really does one side or the other impact metal prices? And from what I remember, some of the information that you and your analysts had pulled, it really doesn't make a big difference, right? On metal, the metal prices aren't impacted one way or the other too significantly.
Yeah, and again, there may be certain points in time or certain months where maybe somebody takes an action and it causes crude oil to spike, or it causes metals to spike temporarily. But the analysis that we did was kind of looking beginning of their term to the end of their term. We actually didn't find any meaningful differentiation between different sides of the aisle or even different presidents. I think I'll just leave it there.
Yeah. Good stuff. Interesting times.
Yeah, sure is. So getting into first PMIs, this is a pretty hot topic right now. First one we're going to look at is the S&P Global, as we typically do. This one gives us a good purview into the global manufacturing space. And if you look over in the top right corner, we've kind of highlighted what I would call the key regions that often impact the United States. We've got the U.S., we have Mexico, we have Canada, China, and then the Eurozone. And what you'll notice is that in the most recent PMI data, we have seen a slight softening in many of those regions. It's not across the board as you go around the world. There are some emerging markets that I would say are still doing quite well. India continues to be on fire. But when you look at China, the United States, which are two very large players within the commodities world, we are seeing some incremental softness. And this is something that's really a theme of the week, I would say, more particularly on the side of the ISM, which we actually just got this morning. And I want to highlight a couple things because what you probably will notice is today's macro coverage is going to be a little bit more somber than maybe what we've had in prior Cup of Joes. And that's just because the data is suggesting it to be so. When we look at the ISM, and I want to point out a couple of these line items, those top four rows, you can see there's a consistent theme of they're all in contraction, they're all sub 50, and they're all contracting at a faster rate than where they would have been last month. I want to put a little extra emphasis on the employment side of things because that one dropped pretty substantially from a 49.3 last month, which is kind of flat, to 43.4, which is a big drop. And it was actually a big miss relative to expectations. And the reason why I want to bring that up is because we obviously heard from Jay Powell speaking about interest rates and interest rate policy for the balance of the year. And I think employment is very, very quickly becoming front of mind for the Fed and for the overall economy. The unfortunate thing is, while everything seems to be softening, there's one area that's not, and it's again back in the Fed's purview. It's prices. Prices, unfortunately, are remaining high, and this is kind of, you take all of these in a summation, it's a bit of a what we would call stagflationary type survey or survey result, which is slower growth, or even in this case declining growth, and higher prices, which is a pretty pesky combo of things. You certainly don't want those those two phenomenon to be lasting for a long term, slowing economy, but yet high inflation. The good news on all of this, and I do want to make sure I throw in a little bit of good news on some of this commentary, down at the very bottom, I've highlighted the fact that the overall economy, not the manufacturing economy, but the overall economy, when we think about services, consumer spending, travel, leisure, hospitality, the overall economy is actually still in growth territory. Not by much, but it is still in growth territory. So I want to make sure that we highlight that fact. It's not doom and gloom across the entire space, but certainly I would say the manufacturing data brought some attention today, and certainly on the employment side as well, because we've gotten a couple data points. Initial jobless claims, obviously the unemployment rate is moving higher, and I've got a chart on that. And I think that's going to become a more and more important piece of the Fed's puzzle and what they're going to do with interest rates. I mentioned I was going to talk about the unemployment rate. This is a basically 70-year chart of the unemployment rate. You can see we're still at pretty low levels. 4.1% is a pretty low level compared to history. But what I always like to emphasize, or what I've brought up in prior Cup of Joes, is typically this tends to be a fairly momentous thing or occurrence, which is job losses. Usually when things start to pick up steam, you can see in all of these prior cycles, when they tend to go up by about 0.5%, they tend to keep going. They don't often just stop and people say, okay, we're not going to do layoffs anymore. I've also overlaid with this chart the historical recessions. And you can see that generally speaking, when we get to this point of having job losses or the unemployment rate go up by around this amount, it's not always the case, but it's pretty close to the case, that it almost always coincides with some sort of recession. Now, that is not to say that we are going to see a recession like the COVID lockdowns or like 2008, which is a very, very difficult one. But a garden variety type slowdown looks like, if we're using this jobs data as a metric, looks like it could be coming. And I think that's why the Fed is actually beginning to take serious notice on this metric and saying, all right, it looks like we may have done our job. Maybe we need to begin taking this more seriously on bringing interest rates back down, try and accommodate the economy, and make it easier for people to borrow for large capital projects, buying a house, getting a car, things like that. So this is certainly an area that I think we're going to get next week, the new print of the unemployment rate. If that ticks higher, I would say, in my opinion, that pretty much guarantees that we're going to see interest rate cuts in the next Fed meeting. But all eyes are going to be on jobs data in the coming weeks.
Is there any indication that it would be a start of multiple cuts? Is there any indication of that?
It's a great question. And actually, that's kind of what the market is saying right now.
Look at that.
I highlighted, so the next time the Fed is going to be meeting is going to be in September. And it is expected, and not just expected, there are 120% odds that they are going to cut interest rates. Now, you're probably saying, well, how do you get above 100%? Well, the answer to that is there are some participants, about 20%, that think that there are going to be more than one cut, that rather than seeing a 25 basis point cut, we could actually, if things start to soften enough within the job side of things, we could see a 50 basis point cut, maybe even something more extreme than that. Now, a lot of you are probably saying, well, why would they cut if inflation is still above trend? The answer to that is, I think we're seeing that the Fed is prioritizing, for now, the Fed is prioritizing the job situation over prices. That perhaps they're saying, maybe we aren't going to get to our target. Maybe we're still going to get there. It's just going to take more time. But they seem to be more concerned about the risks associated with further job losses as we roll through the next couple of months. So, Mike, as it comes back to you, I think, anytime you're thinking about what does cutting interest rates mean for me, if you're thinking about refinancing for your kitchen remodeling project or for buying a car, these types of efforts are intended to spur that type of activity.
Yeah, I can tell you, me and my wife have been on the edge of our seat all year, right? We recently did a kitchen remodel, took out a little bit of a loan, and we're like, well, I said, Nick Webb said the rates were going to be cut soon. So,
I feel pretty darn confident saying here in the next 2-3 months, we're going to begin to see that process, and you should get that opportunity.
Yeah. Good to know.
Yep. And not to pile on the bearish side of things or the somber side of things, but when we flip over and look at China continues to be, and you can see for the last several years, has continued to be, it's almost like waiting for Godot. Everybody's on the edge of their seat waiting for, when is China going to finally prop up their property sector and launch stimulus. What we're looking at here is the economics. I apologize. This is called the credit impulse of China. So this is basically how much new money are they putting into the system to spur economic growth, or how much are they pulling out in order to try and cool things off. And you can see going all the way back to 2005, they tend to be a country whereby they pump big money in and then they pull it out and let things settle back in. Big money in, pull it out. And that was the case for about 15 years. This most recent cycle, I think there have been many who thought that as China was reemerging out of their COVID lockdowns, there were a lot of people who were thinking, well, we're back to the normal cycle. They're going to pile a bunch of money into the system. We're going to see economic growth, which is going to spur things like crude oil prices, commodity prices broadly. Certainly metals prices would be higher, but they just haven't done it yet. And they they just met a couple of weeks ago, their administration did, and they still are targeting 5% growth on GDP, which is a pretty lofty number. But their property sector continues to suffer in a pretty big way. So, there maybe more to the story behind the scenes on some cracks and things in the surface that they're just not ready to address with just a broad stimulus. But I think this is one factor that if we're trying to get a sense of if and when commodity prices may inflect either higher or lower, this is one of those areas we're going to be watching.
So one of the listeners has chimed in and has noted that the current trend looks similar to the trend from about 2005 to 2009 in China. If that's the case, what's coming next is, if it follows that pattern, is a big uptake, right?
Yeah, I mean, it could be one of those things that the longer they wait, the bigger the expectation is for a really big bazooka going into the market. I think it's also worth noting back in 08, 09, that would have been the great financial crisis. There's a chance that there was just more money required in order to stimulate global demand. There was also, I would also make the case that China during that phase of time was also making a massive, massive push into getting people out of rural communities into cities. So there's a very exceptionally high amount of growth within those middle income, high income areas.
I know this seems like it's been a topic, at least on Cup of Joe here, for about a year and a half, right? We've been waiting on trying to bring back their manufacturing, right? Their housing, right? Let's say it doesn't. What does that mean? What are the implications if we don't see them?
Yeah, so I think I'll show you some charts on metals prices here in a second, and it certainly has been impactful to base metals because those tend to be a little more global in nature. But I think as I mentioned, the Chinese Politburo, basically their administration, they met, I want to say 3-4 weeks ago. It was called the Third Plenum, and it's essentially where they plan out the next several years of what they want to do in their economy. Everybody and their brother thought that they were going to come out of that meeting, they were going to announce this big stimulus. When they didn't, the reaction function in the market was copper prices sold off about 15%, maybe 20%. Aluminum prices were on a rally from March, April, May. That's since sold off. And you'll see all this in the data. And I think a lot of that was just kind of the bursting of the bubble of people's expectations of this stimulus. So I think, what does it mean? Well, specifically to commodities, I think it means more subdued demand and more subdued pricing.
Yeah. And another comment here is, do you think that their population can support another boom? They have a younger workforce. I don't know.
Yeah, it's a
good question.
It's a great question. It's not an immediate question, but yeah, the fact that they had the one-child policy for so long, there's people who think that as we roll through generations, they're going to have some issues with getting people into these ghost cities and into these homes where people have several homes that aren't being used to the extent they would in many other regions. I actually just saw a stat yesterday, 2 days ago, that even in Japan apparently one out of every 6 houses in Japan is currently empty, and that's kind of in the same wavelength as maybe what we could see portend in the next couple decades for China, where there are just more and more homes that are being unused and the utilization is just lower.
Wow. Okay.
Yeah. And last but not least, I want to leave us with a little bit of positivity, which is if we look at the overall economy, we look at GDP. This is the Atlanta Fed GDP Now Index. We're still tracking 2.5%. So this is not sky is falling, but certainly I would say in the manufacturing world, we are in the midst of some squishiness, and it's not just the U.S. It's a variety of large economies around the world. Right. And with that, go ahead.
Yeah, I was just saying, nice positive note to make transition on.
I don't want to be Dr. Doom any longer.
Well, I mean, we talk about all this, all the time, right? How interest, haven't cut interest rates, pending recession, right? But I mean, it's good. I mean, it's a good number to see, right?
Yeah, I mean,
Still
I
doing
always bring
okay.
up with some of my colleagues, it's like, there are a lot of people who say, oh, it's going to get so much better when they cut interest rates. Well, I sometimes take a step back and say, well, why are they cutting interest rates? If
Yeah.
they're cutting interest rates because they hit their inflation goal and they know that they can back off, that's your proverbial soft landing. That's a pretty positive situation. If they're doing an emergency cut, if they're cutting 50 basis points, 75 basis points because a bank blew up or because so many people are losing their jobs, all of a sudden that's cutting for the bad reasons. So
Sure.
we want to make sure we cut through the detail on what intentions are. And my opinion is, I think the Fed is beginning to prioritize this thinking around. Looks like there's some cracks in the employment side of things that they want to address because it's a little soft. And not to speak about equity markets too much, but if you look at the stock market today, there are some stocks that are down pretty large, and I would say that a lot of that's related to the weak unemployment data and the weak ISM manufacturing data.
Mm-hmm. Yep, good point.
So with that, I'm going to hop into metals real quickly, and you'll see some of what we just talked about on the macro side reflected within the metals charts. The first of which, I'm basically going to go bearish to most bullish. The most bearish, in my opinion, from a fundamental and from a technical standpoint, I think looks to be nickel. You can see as we sit here right now in the mid to low $7 per pound range on nickel, we're down near 3-year lows right now, and I said that this is bearish from a technical standpoint, but what I would note is I do think fundamentals still look pretty soft, meaning there's still a lot of nickel units coming out of the region of Indonesia. They continue to pump, and I've got a chart showing some of that. But what I will note is from a technical standpoint, thus far, this low $7 per pound range, it has held up. And technical is nothing more than looking at a chart, seeing where prices hit a bottom and inflected higher. And the more times it does that, the more times traders look at that chart and say, oh, maybe it'll do it again. And so far, you can see that it has held up. Now, in my opinion, I still think the fundamentals suggest we could be seeing a bit softer prices. Certainly, as we see manufacturing activity in the U.S. and other parts of the world softening, I think that further feeds into that. But thus far, you can see that, just very, very slightly over on the far right-hand side, technicals have actually provided a tiny bit of support for nickel. Now, when we look at how traders are positioned, and this actually kind of comes back to my commentary around China, between March, April, and May, we actually saw a pretty heavy short covering. So you can see, so this is the commitment of traders report, which shows how hedge funds and money managers position themselves in nickel specifically. And you can see that going into March, they were pretty heavy short nickel. Basically, they were thinking prices were going to come down and they wanted to profit from that. Well, it looks like there was quite a bit of short covering, meaning they took profits on those short positions between the March, April, May time period. As we saw in prices actually jumped pretty substantially. And I think some of that short covering was actually centered around this idea that China would actually stimulate their economy. Well, when they didn't, what happened? Traders basically put their short positions back on. They're now basically as short as they've been in the last 5 years. And so they're back in the mode of saying they think prices are going to continue softer. And so, you're asking what happens when China doesn't stimulate their economy or when they sort of surprise the market to the downside. You get knee-jerk reactions like this, and it's reflected in price as we sit here today.
So just so I understand here, this is the percentage of those who shorted it in March through June, we'll call. And then if you go back to your other chart, that around that same time frame, we're looking at it, the price dropped. So they covered. So basically, they were saying they're expecting it to drop.
Yep, that's right.
And now they're back to, okay, all right.
And the only caveat that I would make to your comment was the commitment of traders report actually shows how many contracts of futures the traders are short. So in this case, one contract represents 5 metric tons. So basically, traders are short right around 100,000 metric tons. So it's not a percentage; it's actually a volumetric short position.
Okay, and a lower nickel price is better for the surcharge of stainless, correct?
For consumers, a lower nickel price is going to cause a decline. All things being equal in the surcharge. That's correct. And then last but not least on the nickel side, this is a 1-year chart of LME nickel inventories. And it's basically tripled since about 12 months ago. And again, a lot of that is just on the, I know we beat this like a dead horse, but Indonesia continues to try and ramp up its market share. And even this morning, the jump in inventories on the London Metal Exchange was the largest in 3 years. So this trend of there's plenty out there, it is continuing. So for now, I'm kind of the opinion, again, just my opinion, that probably best case scenario is sideways for nickel. If I was an odds maker, I'd probably say better odds that we actually see lower prices ahead in the price of nickel. And how long can that last? Like all commodities, it'll last until you start to get either Indonesia or some other miner of nickel say, they throw up their hands, they say we can't make money anymore. And I don't think that price really hits till we get down in the low $6 range, maybe even into the $5 range, for people to say enough is enough, we can't make money anymore. And then you start to get mine closures, and then fundamentals can balance out. Over on the aluminum side, it actually is a similar looking story, though in my opinion, I think the fundamentals look a little better within aluminum. Again, I've drawn in sort of this technical horizontal line, but I would actually make the argument that horizontal line also represents a fundamental support level. And I know we've talked about this in prior Cup of Joes, but somewhere in the 95 cent to a dollar range on LME tends to be that area where, in fact, smelters don't really make a whole lot of money. And in fact, you get smelters curtailing production. And we actually saw some of that earlier this year and late last year. I think a Spanish smelter, Australian smelter closed up shop. And that helps to provide a little bit of support to the market. It's actually interesting, as we came in to the office today, Citigroup, which is a big bank that they cover some commodities, they actually put out a note saying that they think prices could be, by the end of the year, all the way up at $2,500 a metric ton, which is right up around $1.15. Now, we were there just a few short weeks ago, but as I mentioned, as China sort of underwhelmed the market and the momentum turned the other way, those prices went to the wayside pretty quickly. But in my opinion, I think when you get down into the $1.05 area, I think it looks like a pretty safe place to say that, things could certainly go sideways, but I think they'll actually find some support in and around this area. And one of the things that's helping aid that is Chinese aluminum production. We just got some of the latest figures for the last month. Their production is actually coming down a little bit. So it looks like they're taking note of these lower prices and trying to have the reaction of taking some volume off the market. So that should help to balance things out a little bit. And interestingly enough, I mentioned today, like the broader markets, the stock market and everything, pretty big sell-offs in a lot of different spots. Aluminum is one that is not. It's bucking the trend. So while nickel's trading lower, copper's trading lower, aluminum's actually one that's finding a little bit of support in and around this area. So that's sort of a suggestion that traders are beginning to think that the selling may be nearing an end.
And we had Jeff Notice on last month, and we talked about really, it seems like there's been softening demand in a lot of these key segments, right? Like consumer durables and such, which has probably continued to have an impact on this year.
Yeah. And I'd say Jeff's opinion is probably slightly more constructive or bearish than mine. I'm actually somewhat optimistic on the LME price itself. He gets to see a lot of the end demand, and he has a lot of the mill conversations. So I think, his bearishness may be slightly reflected in conversion prices, whereas I think on the ingot side, we could actually see ingot go up a couple cents. Conversions may come down a couple cents potentially in the next 12 to 24 months.
Gotcha. Yep.
Looking at Midwest premiums, not a whole lot of action here. I'm not going to spend a whole lot of time here, but ultimately mostly sideways for the better part of the last 12 months and overlaid against that. So the white line is going to be premiums. The blue line is going to be your flatbed truck rate, which has been pretty darn stable. So I don't expect Midwest premiums to really rip one way or the other, barring, I suppose, with the new administration, if we get massive tariffs in addition to what we already have, maybe you could see that adding a little bit of support. But really, the futures market's pretty flat, and the market's been pretty stable for the last 12 months. So I think it's going to be more of the same as we head into the balance of this year. And then last but not least, on the aluminum side, we talk about the commitment of traders report, how bullish or bearish are the money managers and traders. They're still bullish. They're still bullish on aluminum prices, but I would say it's just a little more muted than where we would have been 2-3 months ago. And again, I think a lot of that feeds back to this idea that they were waiting for China to announce a big stimulus. They were positioned for that, and when that didn't happen, they cut back on their optimism. So I think really it's just, we saw a big run up. I think it just overshot. People took profits when the good news didn't happen, and now they're just kind of slightly optimistic, I guess is how I would summarize the aluminum space right now.
So with all that, what's the headline for aluminum buyers? Be a little optimistic going into the end of the year?
Particularly on the ingot side. On the ingot side,
Okay.
I think there's reason to think that the risk reward is beginning to get a little bit more balanced, and there could be even a slight bit of upside. Certainly if we take these analyst notes as gospel, I mentioned the one from Citi. There are a number of analysts that actually think the basic fundamentals, supply demand fundamentals in aluminum actually look pretty balanced. And when I talk aluminum, I'm talking ingot specifically. I guess I'll reiterate on the conversion side. I think there could be a little bit of softness on like common alloy conversions.
Gotcha. Okay.
And then last but not least, where despite all of the somber or bearish macro commentary that I provided, I actually think I'm pretty confident in saying that I think we've hit the bottom in steel prices. And again, I have to reiterate, this is Nick Webb's opinion, not Ryerson's opinion. But in my opinion, I think we've seen the bottom in both the CRU and spot transactions for a couple of reasons. One is when we look at U.S. prices shown here in white versus the blue line, which is North Europe, and the orange line, which is going to be Chinese prices. I think we almost have to throw Chinese prices out the window because they're so heavily tariffed that most Western nations can't even touch the material because it's got several 100% tariffs on it. But when you look at the spread between the blue line, which is Northern Europe, and the white line, which is U.S., essentially what that means is that there's no incentive to go out and buy imports because there's no arbitrage or price spread to do so. So what does that do? It basically forces buyers who maybe otherwise tended to buy a lot of imports to come to domestic mills. What does that do? It helps to build the order books of the domestic mills and push lead times out a little bit. So I think that's one aspect that's going to help. The second is I think raw materials prices, particularly on the scrap side, have begun to find a little bit of stability after multi-months of declines. So we're beginning to see, it seems, scrap prices troughing out a little bit, which should give confidence to the steel mills to then take that scrap price and pass through a higher steel price. Third, we are expecting a couple domestic mills to have outages in the month of, I believe it's in October, which again, an outage is going to take some supply off the market. And then the fourth thing, which is a little bit more rumor millish, but we have heard through the rumor mill that there have been some pretty large bulk buys by either OEMs or service centers or the tubers, basically trying to bottom fish for deals. And we the pricing on those deals can get fairly aggressive because there are very large tons involved. But when those large tons get transacted, it builds up the order book for the mills. They then get the confidence to take prices higher. And what have we seen in the last 2 weeks? We've seen Nucor CSP jump up by $25 from $650 to $675. We've also seen in the last couple of days a Cliffs price hike announcement to $700. So, we're beginning to see the momentum shift the other way. Certainly futures have begun moving the other way. And that's going to be reflected here in this chart. So the white line is going to be basically your futures curve. The yellow line is basically taking scrap plus $250, sort of your theoretical cost curve, if you will. Taking busheling scrap and adding $250 on it, that builds in, their cost of making steel, their margins, things like that. Is it possible steel futures maybe got a little too optimistic? Maybe, maybe not. I mean, if we look at prior cycles on where prices tend to go when this momentum really starts to build, at least using the last couple cycles, when it starts going, it can get going pretty quickly. I tend to be of the opinion that this particular wave, this cycle in the next 3 to 6 months, in my opinion, it's not going to be quite as strong as the last couple cycles for a couple of reasons. But the main one being, I think the macro side of the economy is just softening a little bit more now than what it would have been in the last few cycles of 22 and 2023. So do I think prices are going up? Yes, I do. In the next 2-3 months, I think we're going to see higher prices. Do I think we're going to see $1,000 a ton? I don't think fundamentals fully support. I don't think they really support that at all. I guess I just kind of hope the mills listen in on this sort of commentary and don't, just get overly excited and keep jacking up prices, because usually what goes up tends to come down just about as fast. And so what I'd like to see is a little bit more stability, maybe somewhere around like 700, 800 in that area, where consumers can still, make money at those types of prices. Producers can make money at those types of prices, and maybe bring a little bit more level-headed, less volatility into the space. But we'll see. We'll have to see.
So looking again, right? So I think the CRU price came out at like 658.
Yeah, 658 was on the CRU. That's right.
Yeah, and Nucor's at 675. So that's probably, is that the first time they've increased? Nucor? It
is the first since the CSP has come out. I believe that is the first time that Nucor CSP has actually jumped up. And I think it's worth noting, if we come back to our conversation with Josh Spores from the CRU, and for anybody who hasn't seen it, it should be out on our YouTube channel.
Mm-hmm.
Highly recommend it. He shared the notion that the CRU, which is another index, they tend to lag whatever's going on in the spot market. So if the Nucor CSP just jumped up by 25 this week, the expectation based on his commentary would be that maybe in next week's CRU, or perhaps the following week's CRU, those CSP spot numbers begin to get published or communicated to the CRU and then become part of the index.
Sense. Okay. Yeah.
And
any
then,
idea? Go ahead.
And I was just going to say, the other index on the Cliff side, yeah, them actually taking numbers up to 750 from 650. So $50 price hike implied there. Those things tend to probably support the fact that they're seeing better bookings, better lead times, and obviously they're hoping that feeds into better prices for them.
And it's fair to note, right, that Cliffs does theirs on a monthly basis, whereas Nucor does weekly, right? Weekly.
They do, although if you remember, Cliffs is sort of subject to change, and I would say yesterday's announcement was sort of a subject to change type moment, where they don't seem to actually be on a monthly cadence, just kind of whatever they want to do, honestly. And that's not to poo-poo them or anything. It is very different than the methodical nature of a weekly CSP.
Yeah. And they're at 750 Cleveland?
They're at 700.
700. Okay.
Yep.
Yeah.
Yep.
Okay. So I was just saying, if there's less change week to week on theirs, maybe they're just building in some price. But yeah, it's pardon me. It's interesting, especially as we kind of near contract season for a lot of folks, right? They'll start looking at these indexes, and it'll be interesting to see what happens going forward.
Absolutely.
Yeah,
absolutely.
Any thoughts on? Go ahead.
I was just going to say, while we're on the topic of contract season, this is a plug for me and my team. We do have the ability to offer fixed pricing on all of the primary products that we deal in. So to the extent, right, you want to take volatility out of your cost structure, we are happy to help out. Quick plug. Sorry.
Love it. No, that's great. Yeah. Didn't mean to get in the way of the plug. I don't know if you had any commentary on this, but someone from the audience is asking, do you think that plate prices are going to lag HRC?
I think the plate market looks pretty soft. Do I think, yes. So do I think while we're seeing carbon sheet prices begin to turn higher, do I think plate is going to follow that directly? I don't. I think the fundamentals in plate look significantly different. They were, we've talked about this a few times, but they were very, very elevated relative to historical norms, spreads to hot roll. They are beginning to come back into a more normalized range, but in my opinion, I think they still have some room to go. I think fundamentals for plate look a bit squishy right now. So yeah, I don't think they're going to follow that trend exactly.
And just to repeat, there's a listener asking to repeat the Nucor number 675. Is that right?
Yeah. So Nucor just went from 650 to 675 on their CSP.
75, gotcha. Okay.
And Mike, yeah, to your point, that was the first time that they've actually taken it higher. So their timing of launching their index was kind of interesting.
Yes.
So last but not least, I'll leave you all with this, which I think I'll give you a quick background on what this is. There's a lot going on this page, but probably 8-9 years ago, I was tasked internally at Ryerson to try and come up with a predictive model that would help us forecast the macroeconomy and to forecast commodities prices. Long story short, I didn't find the perfect crystal ball. If I would have, Mike and I would be off trading commodity futures on a yacht. But
I'm glad you take me with you. Thank you.
Absolutely.
I can drive the yacht.
But what I did create was basically a section for macroeconomy that I think are very good leading indicators that tend to show inflections or directions of where the macroeconomy is going for manufacturing specifically. I also made one for carbon. It's got 7 indicators. Aluminum, I believe aluminum and stainless, they all have 7 indicators. And these are just things that we've come across in fundamental research from all the banks and analysts that we follow. And, sometimes they do a decent job. Sometimes they don't do a great job. But I refreshed it this morning. I actually send this, it's called the Ryerson commodities model. And for the record, I'd be happy to send this out to any internal or external counterparts that we have. But basically what it's doing is saying, based on the way in which certain underlying indicators are going, either up, down, or flat, take all those into summation and say whether that's bullish or bearish for whatever the related industry or metal is. And when I refreshed it this morning, I was actually kind of surprised because it actually reflects pretty closely how my own personal views are on the overall space, which is the macro side of things, as I hopefully conveyed, looks pretty soft right now. The PMIs are pretty squishy. There's certainly some headwinds. And when we look across all these month-over-month changes, only 2 of them are in positive territory. There's another 14 that are in negative territory, which is a pretty heavy skew to the negative side. But what's interesting is, despite all that, the model, which I don't even impact, this is just based on data, the model actually has a bullish slant on carbon and aluminum, which is kind of, I think, what I conveyed here on this Cup of Joe, which is, even though there are some headwinds out there, it still looks like there are some other themes that are taking place in specific metals or specific parts of the economy where there are some reasons to be, you could see prices actually moving higher. And then it's stainless. It's currently spitting out neutral. I'd probably say I'm a little more bearish than that, but I thought that was kind of interesting. I refreshed that this morning. I was like, that's actually kind of what I'm going to be talking about on Cup of Joe today. So I thought that was an interesting little summary. Okay. But yeah, again, if anybody wants to get their hands on the PDF, I'd be happy to send it through.
Yeah, you have the U.S. auto sales in here. That's always been a really big number that you take a look at, right? Because that's consumption of steel.
Yeah, that's right. Consumer. And that number is going to be a month lag because actually here in the next probably hour or two, we're going to get the next number on the auto sales. So that would be certainly one that a lot of analysts are going to be watching.
Yeah. What is the Baltic Dry Index, number 10?
So the Baltic Dry Index is an index that's it's basically for dry freight. So it's a shipping index, basically saying how expensive it is to move product around via vessel.
Yeah, I don't know if you should have let this out, man. This is like premium stuff here.
This is premium content. Yeah. This is normally internally for Ryerson, and it's something that I track every single day. Like I said, sometimes it's very useful, sometimes it's very accurate, sometimes it's not at all. But I don't want to make any promises that you're going to be a hedge fund manager in the next week or two.
But it goes to show how much actually goes into this, and I guess how many things need to go right or wrong, I guess, for lack of a better term, to have things shape up the way they do. So there's a lot of things you're looking at on a pretty regular basis here.
Yeah, and admittedly, when you're in a cyclical economy, a lot of these things tend to ebb and flow together. That if everything's going well, they tend to all move in the green direction, and when things start to soften, they all soften for a couple months or a couple of years. And it really does tend to be like big money in, big money out, and it's just kind of a normal credit cycle or business cycle, I guess.
Nice.
Yeah.
Ready for some questions from?
I'm ready.
Yeah. Someone wants to know what's going on in the copper world these days with everything going on.
Yeah. So if you took the aluminum chart that I put up, I would say copper is a similar story. Whereas if I was to split up the base metals world, I would say most analysts seem to be pretty optimistic on copper, pretty optimistic on aluminum. A lot of those for the themes that we've talked about a lot on Cup of Joe, the greenification themes, data center, AI, a lot of those things require those types of metals for electricity conductivity and lightweighting vehicles, things like that. When you look at some of the more, what I would say a lot of analysts right now are seen as bearish metals, nickel, I would put zinc in that world, lead in that world. Those tend to be a little bit more viewed pessimistically at the moment. They just don't quite have the same narrative, same supply demand fundamentals that copper and aluminum do. So when we think about the aluminum chart and we think about the fact that we did see a rally from March, April, May. We saw that in copper as well. And in fact, we didn't just see a rally, we saw prices go to all-time highs in copper, which we didn't see in aluminum. So the fundamentals are certainly being reflected within prices in copper. We're still within 15% of all-time highs. But was there a little bit of a balloon pop when China came out and didn't announce stimulus? I think that's absolutely what happened. There was a lot of profit taking. I think maybe the prices got a little too far ahead of itself, and when the stimulus wasn't announced, people took their money and ran. So we're still around I think it's like 415, 420 per pound on the price of copper, which isn't too far from its all-time highs, right around $5 a pound. But sometimes these base metals tend to trade in lockstep with one another. I'd say copper and aluminum have kind of been neck and neck for the most part for the last couple of months.
And it makes me think of the chart you put up at the beginning about the industries that could or could not be impacted, right? A lot of those, but the election wise, a lot of those fall into like the electrification and wind and solar, right? All those are heavy copper and aluminum consumers, right?
Yeah.
Listeners asking about the Infrastructure Investment and Jobs Act. Do we know if that's being allocated before the election or after? And if so, what could it affect steel pricing?
Yeah, no, I think it's being deployed in a bit, but I don't think the bulk of it's really going to be coming until 2025, 26 and beyond. In terms of what it does to metals prices, it's going to add incremental demand to the space. But the good news is I don't think, as we're talking about politics, I don't think either administration is going to blow up the key core items within that bill specifically.
And it could impact plate prices. Back to our conversation with Patrick Dempsey.
Yeah. Well, and I think solar, anything related to solar demand is going to impact plate pricing quite a bit as well. That was a big boon for that industry for the better part of 2 years.
Yeah. Another question from the audience. Tariffs in Mexico that were announced in April, as they continue to come into play with the resurgence. Thoughts on how this comes into play with the resurgence of markets in the Americas? I'm trying to unpack that question, right? So thoughts on, I guess this is probably back to your PMI chart, right? Yep. Where we're kind of seeing a resurgence a little bit in the Americas, and is the tariffs in Mexico playing a role there?
Yeah, I think that theme is continuing, which is, Mexico and the United States are growing more interlocked than they have in the past, whether that's for manufacturing or really just, economic cooperation. And I would say it's even the case that Canada is beginning to get looped into the fold. Just in the last couple of weeks, it's beginning to get kicked around that Canada maybe needs to take action on placing tariffs on certain foreign products. I believe it's specifically on China. But yeah, I think all those themes are continuing. In terms of the impact specifically on the tariffs that were announced like 2 months ago, I haven't seen a real major impact on that. And I think, Jim Reed talked about that on Cup of Joe recently, which was a lot of entities have this thing called IMEX, which allows them to essentially circumvent a lot of those tariffs because that product is being done for a certain purpose, or it's ultimately being shipped into the United States. And so up to this point, we haven't seen a major impact that could be at risk. The IMEX could be at risk of getting dissolved, in which case I think you would have probably a heavier reliance on Mexican entities relying on U.S. producers of metal. But again, I think that general trend over the next several years of more cooperation, more economic linkages between us and Mexico and also Canada are going to continue to grow. Yeah. And I would say that probably speeds up under what I'll just call a Trump administration.
Okay. Yeah, makes sense. From what I recall, there was supposed to be a ruling on the anti-dumping countervailing on aluminum extrusions in July. Did that actually happen? Do we know?
I don't know.
I don't remember seeing anything.
Yeah, I apologize. I don't have any color on that one.
Yeah.
I should know that.
We'll kick that question over to Jim Reed, who I think.
Yeah, Jim or Jeff.
Or Jeff. Yeah. We got one more here that is kind of forward looking, but there is a funny comment about speaking of the Olympics, why it's called medals and not medals, MEDALS, not MEALS. So funny. The Cup of Joe audience has got some humor. I like it. Yeah. I don't know the answer to that. Do you know the answer to that?
I don't know the answer to that, but I swear I was actually going to prep a little research on the Olympics and what the medals are actually made out of. But
Is it
unfortunately today's the first business day of the week. I had to do some other like month end closing stuff, so I didn't get time to get around to it. But I'll tell you what, I will actually do some research around this, and I will figure out some details around metal versus metal.
Well, is it short for medallions? Is that why?
I don't know.
That's where I'm going. That's my stake. That's
Mike,
my
I'm
theory.
not the IOC here. Come on.
So we will find the answer to that. We're right up against it here. The last question asks for your gut for a better 2025. Or do you see a similar year to 2024? And I think it's a good way to kind of wrap up this one, right? Like what are you seeing going forward?
Yeah. So there's this long and variable lags. And the idea is when the Fed tends to take action, it doesn't immediately fix things. So, if in fact we are seeing a slower labor economy, if in fact we are slower manufacturing environment right now, and I think, in my opinion, we are, and may for the next several months, if and when the Fed take action, lower interest rates, make the market a little more accommodative, I think it will have an impact, but it's not going to be immediate. So, if the expectation is they begin to cut in September, it likely isn't going to be till maybe Q1, Q2. And again, this is my opinion, not Ryerson's opinion, because this is pretty forward-looking stuff. My gut would say that we wouldn't actually begin to see borrowing pick up in a meaningful way until probably Q1, Q2, 2025. So this long and variable lag thing essentially just means, I think the Fed has the U.S. economy in its best interest, and they will probably take action here in the next 2 months or maybe 45 days. It's not going to fix things immediately. If somebody is going to announce layoffs, they're probably still going to, and that's not a great thing. But these long and variable lags, whether it's 6 to 9 months, somewhere in that range, I think eventually there will be more accommodative conditions for business to operate with slightly cheaper capital markets. And I think 2025, there's reason to be optimistic that it's going to be, I would say, a reasonably better year than 2024.
Gotcha. Okay, great. So just a few things to wrap up here. We have links to both the Metal 103 that we're going to do on additive here at the end of the month. Also a link to that metal perspective. We would love your input on that as well. And a reminder, we're going to do September's on September's Cup of Joe a week later. But I've been kind of holding this one, but I'm excited. We may be talking with a mill pretty soon about lead times, what all goes into lead times. I think it's a fascinating subject.
And it's one that I know very little about within my world.
Yeah. So I think more to come on that. We'll have an announcement probably on that one coming up soon. But before we leave, our Cup of Joe audience has come to our rescue, and on the metal debate. Metal is a flat piece of metal that's stamped with a design or image and is often awarded as a prize for an achievement or contest. Oh, that's just a definition. Come on, man. That's not why they're called metal versus metal. But I think, all right, never mind.
Sounds like somebody got their answer from ChatGPT or something.
Yes. So to be continued. All right.
We'll find this out, and we will share.
And we won't talk to you again right before the big day. So congratulations. And he's off the market, everybody. Nick Webb.
At least in 30 days.
Yes. Okay. Congratulations.
Hey, thank you very much. And I think, in terms of final remarks, I think those forward statements were plenty. So
yes.
Thanks everyone for your time.
Thank you.
We'll do it again soon.
Talk to you soon. Bye.